Good morning. This is Jim Riggio. It's October 9th, 2017, and this is Sunday Muse. Quick disclaimer before we get started. Discussion on a broker-dealer investment advisor. This presentation is used for educational purposes only. We have no way of knowing what level of risk is appropriate for you, and we're not making any trade recommendations. The risk of trading options can be substantial. Please be aware of all trades, all risk prior to placing any trades. And with that disclaimer, we've had yet another week where the market has just continued to grind higher and higher and higher. And Andrew, if you're around, I don't know if I give you the ball or if you can take it.
I think you have to stop sharing.
There we go. I've stopped sharing, and now I think you can just take it. Perfect. You got it. Okay.
Okay, can you see my chart?
I can. And this is perfect, Andrew. This is one we always start with. As you can see in Andrew's chart, that basically since November of 2016, every one of those monthly bars has been higher than the month before. With this starting in November, it's going to be 11 months at this point where we have made monthly highs. I had gone back and I had found only 2 times in history of the S&P where this has happened since 1950 when the S&P started. And so we have this incredibly strong market that really has had very little pullbacks. You can end up seeing that if you take a look also at could you throw the VIX up on a daily basis?
Yeah, just before we do that, look at this month, how there's no tail on the bottom. I mean, they just at the close of last month, they just bought it and it's, it went straight up. At least so far, look at, all these months, there's the market did dip a little bit. Whereas this month, it just went straight up. So in a way, this
month being the current month, right?
Right. Yeah, of course, it's early in the month, obviously, but well, actually, you know what? We're a third over already. October's a third over, so.
It really has been amazing just how strong this has been. One of the challenges that we end up seeing here is that not only is the market been going straight up, but the volatility is, and I don't know if you can get more going back, 20 years on this one, but this one will end up showing you that we're at or near an all-time low in the VIX. When we're trading under 10 in the VIX, it's incredibly difficult because what we're trying to do is we're trying to collect premium. I would say that for our type of trading, that the perfect VIX for us to end up trading in is somewhere between 12 and 20. Okay, because between 12 and 20 on the VIX, it says that there's enough volatility that we can collect money. But once you start getting over 20, then what happens is that the risk of the market moving really, really far and running outside of ranges becomes much, much higher. Most people will end up worrying when the VIX gets to be really, really high. The unfortunate things that we have with a lot of our butterflies, and I know the Kevlar suffers from this. I know I've spoken to people who traded M3s, is that with any type of butterfly or condor where you're collecting premium, when IV gets this low, you're going to have to end up accepting one of 2 things. Either you're going to accept lower profits and losses, by the way, or you're going to have to take more risk. Those are your only 2 choices. And when risk gets to be this high, meaning that you have to pull in the wings of your butterfly or your entire trade is so much closer to the money that there is the potential that if we end up moving. Now, the thing that is probably most concerning to me. Andrew, could we get this chart to go back far enough to see August of 2015? There you. Oh, nope, not quite. Anyway, as he ends up going back there, the challenge, and I think that we have, all of the high frequency trading guys who are already in the market by August of 2015. And what you'd end up seeing once we end up getting there is that the VIX popped up to 50. Okay, there you go. Okay. And it literally did it in 3 days. Okay. So, we sometimes talk about there's not anything such as a V top. But what can end up happening in this environment is that if there is any type of real concern in the market, that what we can end up seeing is the fear rush into the market incredibly quickly. We have 3 concerns today that we didn't have back in, let's say, 2007, 8, or 9. And that greater concern is the fact that there are so many computer-based and algorithm-based trading systems out there, number one, that they tend to end up being very crowded trades. They all move in the same, with the same set of parameters, and hence many times have the same trade on. What that ends up meaning is that when a event happens that can cause real fear in the market, going from a place where we are right now, that it's kind of like yelling fire in a crowded theater. Everybody's going to rush for the door at the same time. This spike in volatility that we ended up seeing in 2015 was the second highest in the history of the VIX, okay, going back over the last 20 years. The only time we were ever higher than this was during the dog days of the Great Recession in 2008. And we got up, okay, at a very, very quick pace. And so because these trades are so crowded, and if we end up having an event that could end up increasing volatility, everybody's going to end up running for the exits at the same time. That's a big issue. What makes it worse, item number 2, is that, as I mentioned, everybody is a computer-based trading, so it happens much, much quicker now. The third part of it is that there are so many VIX-based products. Back then, not a lot of people traded VIX futures or VIX options, but now we have all of these VIX-based ETFs and ETNs. And so what can happen, JD, I don't know if that's you. I'm just going to put you on mute, so if you want to end up speaking at any time, just unmute yourself, okay, because I hear background noise. Anyway, so with all of these VIX-based products, okay, it'll end up making the movement even quicker. So, Paul Demers and I were talking on Friday. We spent the day together just going over the markets and different things. And one of the things that we talked about, okay, with all of these VIX-based products is that back testing, say pre-2013, 2014, we don't want to ever say it's useless, but the dynamics of the markets are so much different now because there's so much more computer-based trading and algorithmic-based trading that the movements of the way the VIX can end up spiking, it can be rather dramatic. Now, one of the things that we also ended up showing, and I showed on a roundtable 2 weeks ago, was that the daily movements of the S&P have gotten to basically all-time lows when you take a look at how much they're moving per day, or ATRs, right? The ATRs are the average true range. And when you end up taking a look at average true range, all it is the high minus the low for every day. And when you take a look at that, And Andrew looks at a 9. It really is not that important. You can look at a 9, Andrew. I look at a 7, but it really doesn't make it. I look at a 7, but it doesn't make that much of a difference. So, and so when you look at this, basically it's taking the last 7 days. And the only reason I look at 7, okay, is that some people look at very, very short things like 5. Other people look at longer things. I think 14 is the default. By shortening it up a little bit, you get that little turn. Okay, you see how it started to turn back down? When you get these very small trading ranges, you take a look at this. What this is basically saying, and I'm going to guess that's about a 9 right now, it's saying that over the last 7 days, the S&P has had a 9-point range per day on average over the last 7 days, right? 9 points from its high minus low, including any gaps. Now, the challenge with looking and comparing ATRs, and Andrew, you brought this up at one point a couple of months ago, was that the ATRs of the S&P were actually smaller than the ATRs of the RUT. Now, what makes that a really shocking statement is that the RUT is almost half the size in terms of its value as the S&P. Right? Yeah, because I mean, we're up above 2,500, where the RUT is around 1,500. Okay, and so it's 1,000 points more, but yet we have a smaller daily range. When you take a look at it, it's not the way that the ATR is supposed to work, but if you really wanted to compare them, instead of doing it as a number of points, you would look at it as a percentage. Now, if I look at these ATRs as a percentage, and then I go back and I look at the history of the S&P, what you find that if we look at it as a percentage, we're again at basically all-time lows. Now, when you take a look at this, it's kind of weird in the sense that if you look at today's world, you would end up expecting with, you know, political unrest, okay, on the Korean Peninsula, you know, all of the stuff that's going on with the Russian government, and not only just with, you know, the impact that they may or may not have had, okay, on the U.S. elections, but you take a look at the way Putin has been running his government and the conflicts that they've had in Ukraine and Crimea, and you take a look at all of the other things that go on and about how volatile and how quickly things can end up changing in this world. How could we be at all-time lows in volatility measurements, both what we think about the future, that's implied volatility like the VIX futures, and realized volatility, things like ATRs, okay, as a percentage of the underlying? How could we be this low? And the answer is that since there's absolutely nothing going on right now, because the markets feel that the government is not going to end up doing anything to substantially change the way the economy is right now, because they're kind of deadlocked on everything. That's what will end up happening is that if things do start to move, they also feel that they have the speed to which to end up changing their positions. And so we get these days, day after day after day, where very little movement's been happening. And this has been going on, you know, pretty much since we stabilized after the bounce of the U.S. Elections. And so when we take a look at this, there's an extremely high probability that we move higher into the end of the year. There's no item on the horizon that can end up really worrying people. The geopolitical stuff of North Korea has and the Korean Peninsula has been the only thing that's really set the market, you know, to end up having even the slightest pullbacks. And so it's been just a major, major issue. No, Andrew, that's a good line to draw if you want to draw that line, because one of the things that what Andrew's going to end up drawing here on this line is that when you take a look at any of the channels, and I'll try to take the ball after this to show, because I have this drawn out. But one of the things that's happened is that we've been in this uptrend, and now we've had an acceleration of the uptrend over the last several months. If you take a look at that uptrend line that he's drawn, and if you drew another one that was longer term, you'll see that not only have we been moving up, but right when everybody started talking about us being overbought, we actually started to accelerate the move up. This has to be probably one of the most hated market bull runs that I've ever seen in my life. I think that on Wall Street and in a lot of other places, the elections created a lot of emotional disagreements between the left and the right. I think that the people that dislike him really dislike him. The people that really like Trump really like Trump. And what ended up happening is that everybody said about how dangerous he would end up being. And so there was all of these predictions originally about the market going down if he was elected, and it's just gone up. And it's made a lot of the analysts look pretty foolish. And after, they ended up justifying, more infrastructure spending, tax cuts, of course the market's like this, but we're in an overbought situation. And as they started to end up saying how we were in an overbought situation, did we end up reaching a top and moving down? No. Did we keep at the same pace that the market was increasing? No, we actually started to end up increasing over the summer, and the speed that we started to end up moving. If you take a look at where we've moved since mid-August, and you take a look at, if you were to draw any trend lines in there, we've actually had an increase in the steepness of going from lower left to upper right. So in this environment, one of the things that Paul would always, be fond of when I would say, when we take a look at how long can you last on the upper end of a trend line, how long can you last on the upper end of, pick your favorite oscillator or momentum. I use the term that sometimes we can live on the ceiling, meaning that just because we're in an overbought situation doesn't mean that we can't continue to end up moving higher, especially in environments like this where the larger money managers, right? The larger money managers, the ones that are managing, billions or trillions of dollars, are sometimes, they hate these small, high frequency guys because it makes their job more difficult. They can't go in and buy when they need to buy. They have to try to disguise their buying so that the high frequency guys can't end up getting in. The other thing they need to end up doing is that they need to disguise their daily movement so that their ranges don't move too much, because if their ranges move too much, the high frequency guys can end up making more money. The other thing they have to end up doing is that when the market goes to sell off, when the market goes to sell off, the high frequency guys love that, right? The algos love that because usually we go down much, much faster. So what ends up happening is that the guys who are managing longer term money use every single pullback as a way to deploy more money. Now, the problem is that when they deploy more money, okay, if you want to see volatility, the way they deploy more money is that they buy the dips. Every time the market sells off, it's like, okay, there's some sellers out there. We can finally end up getting some more money to work. And so they put more money to work. And so that the volatility, because of this, and the term that is used, by the way, is latent demand. Because there's this latent demand to end up buying more stocks, and the smarter, larger institutional money managers are putting money into the market at a slower pace, it really is, one, not allowed the market to really ever sell off, since the U.S. elections. And two, you get this very slow, grind them up method of being able to just move the market higher and higher. By keeping the daily ranges very small from an institutional point of view, okay, from a large money point of view, what you're doing is that you're really stepping on the high frequency and the algo guys. The high frequency and the algo guys, as I mentioned before, right, they live to see volatility. Okay, the big institutions that have much more money and much more power are trying to squash them. And we're seeing that happen in 2017. And so you have this dynamic of there's so much more money on the sideline to come in that there's a very low chance that we start to end up seeing a hard sell-off unless we have some type of event where there's a catalyst that the bulls don't want to end up being strong bulls anymore. Andrew, anything you want to end up adding to that? Because I know that you look at this very closely.
Well, one of the things that I find interesting, if you look at the average true range, is that it kind of justifies trading the same size structures in the market. Sometimes people ask, well, when the S&P was at 1,500, you were trading, a 50-point or a 75-point wing butterfly, and now that the S&P is at 2,500, shouldn't the butterfly be bigger? And if you look at the average true range, no, the size is fine because the movement hasn't changed, even though the overall price of the index is much higher.
It's very, very true. One of the things that ends up happening is that if you take a look, and a lot of people I know like to end up setting their short strike or their long strike, or they'll set something up based on a delta. Okay, I'm going to sell my short puts at a 10 delta or at a 12 delta. Well, what happens is that when volatility contracts, meaning the VIX gets very, very small, what you'll end up seeing is that if you go back and take a look at how many absolute points you were starting your condor or whatever at that 12 delta, you'll find that when the IV shrink, you have to bring that 12 delta comes much, much closer to the money. Okay, that's a really important point that we never bring up. Andrew, I don't know if you have the possibility to do this. You know what? I think I do. I know I do on Thinkorswim. Paul, are you online? Otherwise, I think what I'll do is let me try to take the ball and see if I can do this with the speed internet. Okay, let me see if I can come over to here. And let's see if we can do this. Okay. You can see my screen, right? Is it sharing now?
Yes.
Okay. So here's that long-term channel that I talked about, and Andrew drew one of these. And this goes all the way back to the end of 2015, beginning of 2016. And you can see this nice upward channel, very clearly defined, relatively tight channel that we were in for most of the year. We broke above it. If I take a look at, well, what's happened this year? We broke above it in February. And since February, we've been working on both sides of this upper trend line of the channel. Now, here was and that's in the aqua, okay, that I pointed out. If you take a look at what's happened since the end of August for the last month and a half, the movement higher has actually accelerated, okay, the way we've moved up. And let me just show you so it's a little bit easier to see. Okay, you can see how we've moved up, and we have this pretty clear defined channel that has actually accelerated to move higher. And this has been just, a really big move. One of the things that ended up happening is that you can end up seeing in this area where in mid-September, where the top line, and this is why you draw these things, by the way, guys. Take a look at this. There was definite resistance at this line. I'm not the only one in the world that drew this channel. This channel is like on every high frequency and every algorithms that they end up using. And so that they tried to get above it when they couldn't, okay, it sold off. But then when we did break it, look at this incredibly strong day. After we did break it, it just kept marching higher and higher and higher. Many times what we're independent is that when you have a resistance line that will hold, it'll hold, it'll hold, it'll hold. Then when it's broken, you break through it in a big way. Where will we end up pulling back? This trend line will now end up acting as support. Many times, and you can see what happened here, right? Many times as we tried to get through it, it took a while for it to break through. Same thing, this is probably even a better example in the month of July. Look at how it's testing. Then when it finally did break through, we broke down in a ways for at least a couple of weeks. And so right now it's come back down. We'll have support, somewhere around this trend line. When we ever get there, let's call it in the 25.30 area. But this 25.09 area will end up being a pretty strong support level. Because if you take a look, 2,500 or any century mark is always a really big deal. And I didn't draw the line at 2,500, and I will at some point. But just the way we did at both 2419 and at 2406, I've drawn it on other ones, there were these resistance points, or so we finally broke through that became support, that when we ended up having big sell-offs, okay, on a day or, a single day, is that they didn't get all the way down to, or break the major the major support line. I think the same thing here, right? When we sold off, look at what we sold off to, okay? Previous support lines. Look at when we sold off here, okay? It took them a couple of days, but we get down to the 2419 level. So these support and resistance levels, in my opinion, the trend lines, support and resistance levels, or your charting ability, has totally replaced things like your oscillators, your MACDs and your stochastics, and all of those things. It's made the technical trading less important because everybody sees those also. And a lot of times people would end up trading them, day traders would end up trading them. Oh, you know what, my CCI just got to this point, so therefore I'm going to end up going long. And many times, I used to call them crack and snaps. I don't know what the official term is. That's just the slang that I use, where they would crack through a particular, oscillator level or momentum level. They'd go take it a couple points below it. Everybody would stop themselves out, and then they would snap it back up. And so that happened all the time, and it really killed day traders' ability to make money using their older techniques. These techniques of being able to map out, your trend lines, your support lines, these have to either be done by, algorithms or by, somebody with a little bit of experience and manual work. And that's what it is. It's all I'm looking at is where have you been? What have you done? Because there's a strong chance that if you've been someplace and you've done something, okay, that level is going to end up holding until it, it's going to end up breaking. And since because we have this latent demand, okay, where we know that the bulls are going to end up getting continued purchasing through the end of the year, that when we come down to any type of level that's a support level, you see the market's off it. Why do I keep saying through the end of the year? If you're a money manager, and I don't care if you're a mutual fund manager and you have a bunch of money in publicly traded mutual funds and you have a lot of small investors. I don't care if you're a institutional manager and you're running money for huge pension plans. I don't care if you're a money manager and you're putting the same strategy like Goldman Sachs or JP Morgan or any of the larger institutions where they'll have their strategies, and now you have to sit down with your clients. At the end of the year, how do you end up telling them, well, we missed the entire rally because we didn't believe it? They have to be in the market, right? Because if they're not in the market right now and they underperform, they're going to end up getting fired, and their clients are going to take their money someplace else. There are two reasons why, okay, money managers get fired, okay? And it really comes down to this. Number one is they lost money. Yeah, but the market was down 30% and we were only down 28%. I don't care, you still lost a lot of money. If you lost 10% and the rest of the market's down 30%, you'll keep your job. The other reason why you end up losing money is the client comes in and says, all my other friends made money, the S&P's up this, all the other indexes are up, I underperformed everybody. Why did you underperform the market so much? And they end up leaving. It's funny, right? They leave for the two opposite reasons. So what ends up happening right now is that there are a lot of individuals, companies, institutions, strategies that have not kept up with the overall market. And what they're trying to do is that they're trying to buy dips right now in a last-ditch effort to try to make up what they've lost in the fourth quarter. Now, what will end up happening is that this March, because everybody's in the same boat, this March should most likely, with a high probability, continue to the end of the year. What happens at the beginning of next year? Well, now there's 12 new months in the year, and so the market be free to end up moving the way it wants. And yes, there may be a serious pullback, serious being more than just 3%. But to have that happen before the end of the year, very unlikely. If there are pullbacks, okay, in the second half of the year, they almost always happen before the middle of November. Okay. If you look back through the history, you can go back in history and take a look at and here. Let's do this. Let me see if I can go back 20 years daily. And let's go back to 2008. So here's this huge sell-off that we have during the financial crisis. And let's take a look at what happened during just the fourth quarter. We were flat. Okay, the market didn't move that much. And so when you take a look, and if you take a look at, well, how did you do during December expiration? You're actually up. If you take a look at how did you do during December month, we were actually up, okay, during 2008. If you can end up being flat or up, okay, in 2008, okay, in December, you could do it in any month. So what you find is that it's not the strongest month, but it is the month with the lowest volatility. This can be seen in the following, and hopefully this will come up relatively quickly. Okay, it's up on my screen. Can you guys see it?
Yes.
Okay, here's what you're looking at with this rainbow here. Okay, first of all, the daily chart. Okay, I'm sorry, it's a 15-minute chart. It's an intraday chart using 15-minute candles. Okay, and what we're looking at in the candle charts are the VIX. Okay, you can see that down here on the bottom. As I go up, what I tried to end up doing, and I couldn't get the colors of the rainbow. I couldn't find Roy G. Biv, anybody who freaking took chemistry back in the 80s or 90s like when I did. I couldn't find the exact colors of the rainbow, so it's close. Okay, so I start with this, it's not violet, it's bright blue. If you take a look at this V7, V stands for, right? This is the futures for October 2017. V stands for October, 7 stands for 2017. And what you can end up seeing is that exactly what you want to see in a bullish. You want to see all of the futures go from upper left to lower right, coming down to get closer to the VIX. Now remember, the VIX futures are free to float any place that they want. However, they settle, right? They settle, excuse me, on the price of the actual spot price of the VIX. So that means that between now and next Wednesday, when this front month expires, oh, by the way, yes, Wednesday, right? For those of you who've never traded VIX futures, they expire or settle on Wednesday. They don't expire on normal Fridays. 2 quarters out of the, 2 months out of the quarter, they settle on Wednesday before normal Friday expiration. On 1 month out of the quarter, they expire the Wednesday after. You can go to the website and take a look, or just look at any options chain or future chain, and it'll show you. Anyway, so what ends up happening is that we know that in another week and a half or so, that this blue line, the front month VIX futures, and the actual VIX, this candle chart, they're going to have to end up expiring at the same price. Right now, if you take a look at the difference, there's about 0.9, okay, of a point difference between the two of them. If you go back a week and a half, you'll find that in some spots there was 2-point differences between it. So they are getting closer. Why are the VIX futures usually higher in a normal market? Okay, that's known as contango. And by the way, all that means is that if you take a look at the front month here in blue and the second month in aqua, it just means that the front month is lower than the second month. This is very normal type of chart. You take a look at when we ended up having a slight bit of a sell-off on Monday morning, okay, 2 weeks ago. Look at how much the VIX moved up versus how much the VIX futures moved up. So when you see the VIX move up much, much more than the VIX futures, number one, there was already a cushion in there, so there was nothing really for them to be worried about. But when you end up seeing this, it's saying that this, there's no panic. It's, yes, there's some selling, but people aren't going out and buying puts, okay, and trading their firstborn, okay, male son for a put. And so when this ends up happening, it tells you that the selling pressure is only going to last for a shorter period of time. One of two things is going to happen. Either the selling pressure is going to continue and it's going to get worse, in which case you will see the VIX move higher. But if the VIX future, right, the VIX futures move higher, but if the VIX futures move higher, it means that we're going to settle out, okay, and the S&P should end up finding a bottom relatively soon, and we're going to start to bounce. And that's what happened here. That's exactly what ended up happening. And what happened the next day? We continued on our merry way for the VIX futures to get small. This is probably one of the best, or what I call elephant footprints, that you can end up ever taking a look at, is to see how the VIX versus the VIX futures, and not just the front month. Sometimes they're sneaky, right? Sometimes you'll see it happen in the second or the third or the fifth month. But we're in what I call perfect contango. What I consider perfect contango is that the October, which we have right here, is lower than the November in aqua. And the November in aqua is lower than the December in green. And the December in green is lower than the January, which is yellow. And the January, okay, is lower than the February, which is in orange. And the February is lower than the March, which is in red. And so when you end up taking a look at the distance between these lines, it's very, very normal. It's kind of standard. People sometimes ask me, but Jim, there's a big gap between December expiration and January expiration. Why is December so much lower? And I like to end up saying, being a little bit sarcastic and tongue-in-cheek, is that the algorithms, okay, and the computers found out that Christmas happens in December because December has the lowest volatility, right? Because even during 2008, okay, we didn't have a sell-off in December. December volatility always tends to end up being lower. Hence, the VIX futures for December, okay, will end up not being exactly in between November and January. It tend to end up being much closer to November's, okay, so it'll end up being lower. So this is normal. If you try to end up comparing this chart, okay, and you don't realize that Christmas happens during December, you're going to end up thinking that, ooh, there's something the matter with this chart. And quite frankly, if there was, say if this happened and this was March, okay, and this was April, I would be a bit concerned. What would that end up signaling? It would signal that there's something that's going to be happening, okay, during this month, okay, that the market's very, very afraid of. What could that be? It could be something like a big election, okay, that may end up changing the course of the way the markets end up moving. It could be a Fed meeting at a critical point when they're about to, interest rates are about to change. So it'll be some type of an event risk that has pushed January higher. It's not that it's pushed January higher, it's that Christmas happens and it's pushed December lower. So it's perfectly normal. So understanding your markets, understanding why things end up happening. If there's going to end up being any type of turn in the market, this is where we're going to see it first. The VIX will pop up a little bit, but it moving. I mean, does it really make that difference? Some people like to talk percentages. Ooh, look at this. We went from 9.5 up to 11.2. I was like, oh my God, that was such a huge move. That was like a 15% move. Okay, guys, if you're not talking, if I could ask you to just kind of put yourself on mute. And so, oh, that was like a 15 or close to a 20% move in the S&P. I'm sorry, in the rut. That's a huge percentage move. Yeah, it's a big percentage move. But how excited can you get when the VIX goes from 9.5 to 11.2? It's not like 11.2 is panic. And what did the VIX futures think about it? They thought it was a non-event. Okay. When the VIX futures start to end up telling me the move in the VIX is hitting them, that's when you have to start to get worried. That really hasn't happened for some period of time. If I go back and I take a look at, let me look at this. have to go back a lot further. Let me go back, say 90 days, 1 hour. Okay, and I want you to take a look at what ended up happening. In here. Now, what we're looking at in here, I don't know if you can see the dates right there, by the way, when I hold my cursor. Over here, this was during early August. You can also take a look at what happened over here. This was the end of June. We see a lot of this, by the way, where you see these spikes. Look at how big the spikes are in the VIX versus how big spikes were in the underlying, in the VIX futures, right? Much, much smaller. If I highlight this area, okay, what you can end up seeing is that the VIX got all the way up to 16. And don't get me wrong, the VIX futures did go up, right? The VIX futures went from 13 up to 15 and a half, where the VIX itself went from, you know, under 9.5 to 16. If you take a look at how the VIX futures moved up, yes, the VIX futures got higher. Yes, the second month got higher. But if you take a look, we really never got out of the complete, you know, perfect contango. We were almost always, maybe an hour or two in the afternoon, but we were always at the point where even when things got to be scary, that the VIX front month future, I know it was the front month back then, but if you go and you take a look at, well, what happened with the October contract versus November contract versus the December contract, yeah, they went up, but it wasn't substantial. When you start to see the front months really get above the previous months, and that happens for not just, you know, the first and the second month, but also happens in the second and third month, or the third and the fourth month, and things can get quite scary. If I end up going back and I take this over a longer period of time, and move this here. I don't have the VIX futures contracts, but if you go and you take a look at what happened in 2015 during this period here, by the time we ended up getting to Monday, okay, because this was Thursday, Friday had an expiration, and then this was the next day. This was scary. By the way, Mondays after expiration always scare the crap out of me, because what happens is I don't know how many people have successfully rolled their protection. If you take a look at some of the biggest sell-offs we've had in history, they've been compounded if they were the Monday after expiration. And some of you might be going back and trying to figure out what happened, okay, on Black Monday in October of, on the October crash in '87. I'll save you the time. It was the Monday after expiration. Okay. And so people are putting their protection in place. So you always have to be a little bit careful after expiration. Now, having said that, excuse me, many times what will end up happening is that you will see volatility drop. Why? Because people who sell covered calls and a lot of other things need to end up selling their options for the next month that they're going to be rolling. And there are, excuse me, a ton of strategies that the big banks will put in place for the wealthy, where they're saying, well, you know, bonds don't pay anything, so what we're going to do is we're going to put you in a dividend paying stock, and we're going to sell covered calls against it to be able to generate income. And so what happens at the end of the month where they ended up selling them, and they don't sell them every month, right? That'd be too much work. So they'll sell them, like, say, on a 3-month rotating schedule. They have to sell more options the following week. And so many times you'll end up seeing, okay, volatility drop the Monday after expiration. However, every once in a while, it's just going to end up, it's going to shoot. So just be aware of Monday expirations, Mondays after expiration. Those are the big things that I had. Andrew, Paul, anybody else have any comments or things you want to end up sharing? Okay. If not, I'll just Andrew.
Yeah, you know what? It's like deja vu. We've basically been having the same conversation now for a while. You know, until there's a change in the market, I think we're going to see more of the same.
Without question. Two comments. One of the things I just wanted to end up showing you is, and this was the green here. This is just the daily chart using 5-minute bars. One of the things that you can end up seeing here is that we moved even higher. Okay, if the green bars over the last couple of weeks have actually increased the acceleration that we see. As for seeing the same thing over and over again, I told somebody, I use this once sometimes. You guys may have heard this. It's almost like where Bill Murray in Groundhog Day. Did you see that movie?
Yeah.
Do you remember that movie, Andrew?
Yes.
Right? Every single day, Bill Murray lived the same day over and over and over again, and everything happened exactly the same. Do you remember what event happened that he actually realized that it wasn't going to be the same day?
It's been a long time since I've seen that movie.
I like the analogy and have funny, so I watch it. What ends up happening, okay, because every day his alarm clock goes off at 6 o'clock and he lives the same day. However, okay, when the first day that he's not going to live the same day, his alarm clock goes off at 6 o'clock and you think it's going to be the same day, except for Andy McDowell, okay, the model actress, wakes up in the bed next to him, okay. Now, when will this stop for us? It's not going to be as subtle as having Andy McDowell wake up in the bed next to you. Okay, but you do need to end up looking for your elephant footprints to end up seeing what's going to end up changing it. There's going to be a bunch of false signals before we get a real one. You'll see that in the fear, the speed of the VIX futures, the speed that we ended up moving. One of the things that even happened on Friday, if I ended up showing you the XBX on Friday, and I did this on 1-minute chart. Okay. It was interesting because there were short periods here at, let me just draw them real quick. I'll show you what I was.
Is that the right index you want?
No, it is not. That's the one that I wanted. Thank you. Okay, here's Friday. Look at what happened Friday. You have like this circle here. You have this circle here. You saw some selling pressure. Okay. I hadn't seen this in a while. Okay. Where there were at least short periods of times where the bears were actually willing to end up stepping in, okay? And when we came down pretty quickly. If you take a look, continue today, okay, that we've had this pressure. Now the question is, can they continue it? They're trying at periods of time. Now, what is happening is that if larger money managers are trying to get out of positions, okay, it shows that they're selling, okay, or if there are any types of selling pressure whatsoever, they're selling pressure, but they're not doing it in a sustained way. They're kind of hitting them with bursts, okay, bursts that the high frequency guys and the market can handle. If these downward spikes get to be worse, steeper, and for longer periods of time, then you start to end up worrying. As long as there's this, shorter period of time, it's, one money manager trying to get out of positions. You start seeing that if that triggers a second money manager getting out of positions, and that triggers a hedge fund getting out of positions, and that triggers a pension plan getting out of positions, you know what I'm saying? You'll see it cascading. But for right now, there really isn't a ton of pressure.
I know if you put up the futures and you look at the volume, it's the volume's a little elevated, but nothing spectacular.
you know, when you take a look at here, let me get this. Okay, and again, since Friday. Okay, you can end up seeing, one of the things I take a look at all the time is I'll take a look at the overall volume. Okay, and this is shorter term volume. And so you can see that the spikes and what ends up happening. But I take a look at the following. If I take a look at volume totals. Okay, when was there selling? Okay, and when was there buying? If they're selling, and by the way, all you're looking at here is on the top, you're looking at the total volume on the New York Stock Exchange. On the bottom, you're looking at the total volume on the NASDAQ. Okay, and so when you take a look at the volume, and I break it up by hour, okay, you can see each hour here. Normally, you'll always see the first hour and the last hour being the strongest. And so what ends up happening is if on a daily basis, our big down days are on huge volume and the recoveries are on smaller bounces, then you start to worry. But what ends up happening many, many times is if I go and I take a look at, let me just go take a look at this again. And let's look at something like SPY. Okay, and I'll take a look at the SPY on a daily basis. Okay. If you take a look at, well, what's the selling look like on specific days? Now, if you come and take a look over here, you can see that, and this is normally what's going to happen, right? You'll see that the big selling, okay, was on a very high volume day. The next day, we were relatively flat up a little bit, but the volume wasn't very high. This is what you would expect, and this seems to be very bearish up until 8:17. 8:18 becomes very, very bullish, and here's why. They tried to take the market down, and they couldn't take it much further down. Why? Because every time volume came in to push the market down further and further, bulls would step in, and you would end up seeing the volume come back up. On an intraday basis, it's critical to watch the down, I look at one, for this I look at 1 minute and 5 minute charts. If every time they try to push it down, the biggest volumes are on like the recovery bar or the bar one after the recovery bar, it meant that the bears were trying to sell off and the bulls just bought everything that they could throw at them and then some. Okay. And if the upward movements are on higher volume than the downward movements, that is about a bigger elephant footprint as you can possibly find. Okay. And so if we end up seeing, okay, if you take a look at this day, okay, Friday, we had both up and down days, and the volume was higher than some of the big up days. Now, this is not very bullish, by the way. If you take a look at this, you have this huge up run. Remember, I ended up showing you it was this day that broke us above the channel, right? 919. Do you remember that? Okay, I'll show it to you in a second. We'll go back to 929. But if you take a look at 929 and then the Monday after that, you had a very big volume on this Friday, and that ended up helping us to kind of break out of the range. This becomes very bullish. As you go higher, now you take a look at this huge up day, where we finished at the top, the volume isn't very high, not compared to what it was in some of the other selling. If you take a look at, well, what's happening here, it was kind of like they tried to move it higher, but they couldn't. So it'll be interesting to see that if we do have any type of, what the volume will end up being. But remember I told you how critical this day was because it was on higher volume? If you go back over to here to take a look at this. Okay. Oh no, wrong one. Right over here, there's 929. So you had that huge volume first that got them above the trend line. And so, you know, it's, some people say, you know, well, do the markets react to the trend lines, or is because it's a known factor that the markets end up just reacting? They don't predict. Everybody reads the same thing. And yeah, it's probably more everybody reads the same thing. And so at this point, I really don't care. I just want to end up seeing, making sure that I have my support lines and my trend lines in places where the rest of the markets do. And the fact that they needed so much volume to break through, okay, the trend line or the channel is important to see that. So, Andrew, any closing thoughts?
No, not really. You're still waiting for the market to kind of behave normally. Usually when you have a breakout, the market likes to come back and at least test that breakout, and it hasn't even done that.
It hasn't. It really hasn't. Two things that I'll end up stating here. For those of you who are really into technical analysis and taking a look at momentum, if you take a look at chart patterns, I'll speak specifically, by the way, to all of you IBD guys, right, where you end up seeing patterns, okay, in different things. And let me come over here. And so if you end up taking a look at this pattern right here, you see this little U, okay, and then you end up seeing this other little pattern over here. This is called a cup, okay, and I don't know if I can can I draw here? No, I can't. Maybe I could. Hang on, let me try to do this. Okay. Yeah, no, I can't do it on here. I thought I could. Never mind. Anyway, if you take a look, here's the cup, and then here's the handle. Once you break out of the cup and handle, you tend to end up moving up. What happens almost all the time is that when you break out of a cup and handle type pattern, you come back and you end up testing, okay, the highs of the right side of the cup or wherever you were. And if you take a look at this, you definitely test at the top levels of the cup. If you take a look at this type of run up here, where you have this breakaway top, what you normally will have happen is that you'll come back and you'll end up testing previous highs. Now, the clearest line, okay, where we would end up coming back to test is 2509. Is that possible? I would tell you it would be a very, very healthy market. I would be more concerned if the market keeps running up and doesn't test it. I tell you, from a technical perspective, the thing that concerns me most is that we have a double gap here on 2 Mondays in a row, right? If you take a look here on 9/11 and also on 9/5, on 9/5 we gapped below this area, and on 9/11 we gapped back above it. We had a sequential gap, meaning we had a gap on 9/11 and another one on 9/12. Well, this little sell-off, okay, that we ended up having on 9/25 was enough to fill this gap. It wasn't enough to fill the gaps previous to this. So not only do I have a 2509 that I think becomes a really important level if we do have a pullback, always 2500 will be an important level because it's a century, but it's down in this area around the 2475 area, maybe going down to 2465. That is a major area. If we ended up having a sell-off down to here, I think that would become a huge buying opportunity, and you would see just a ton of people step in. I don't think we get back down there, though, anytime soon. We have too much strength in the market right now. Paul, you've been quiet. Anything you want to end up closing with? I don't know if he's still on.
I'm still on. Sorry, I've been trying to buy the dip.
Oh, Paul, I love your sense of humor.
It's incredible. Even that buy the dip thing doesn't work anymore.
Anything, Paul? Anything else?
No, I think my sarcastic humor was enough.
And it's always welcome, by the way. Guys, looking at the chat. Anything in the chat? I don't see any other questions. Okay. If there are no other questions, I really appreciate it. Thank you, everyone. And we will end up seeing you next week. Just one quick comment, and that is that I had done a roundtable where I talked about, I ended up trading, okay, this market, or at least how to take advantage most of the way. And I showed that the way to do it is to sell the really, really high implied volatility below the money and to end up buying the really cheap volatility above the money, relatively speaking. And I talked about how the structure is actually similar to that of a structured note. It may not be appropriate for you guys who want to end up being active traders and trade every single month, but if you're looking for something with the best risk reward ratio that you could possibly find, I can show you something that has a 6-to-1 chances of you winning. You'll win 6 times and lose once, according to history, but yet it's a 50-50 bet. If you want to actually see how I construct that trade going out a year and a half, please join me on Wednesday. I'm going to show you how to end up during it. And by the way, you'll put on once and you won't touch. Okay, and so it's taking advantage of what the market is giving us right now. I think it's extremely appropriate for a small amount of money, even in mom's IRA. Okay, so hopefully you'll be able to join me on Wednesday at 2 o'clock. Until then, thank you, everyone. Thank you, Paul. Thank you, Andrew. Thank you for attending, everybody. I'll speak to you guys soon.